Hi, my name is Kirsten. I'm a CPA and accounting instructor, and I'm here to help you master the Accounting 101 concepts that you might be struggling with. In my previous videos, I've talked about things like, what are the 4 financial statements? Why do we have financial accounting? And even an introduction to our basic account types in financial accounting. Today, we're going to be breaking down how to build a journal entry and the process of figuring out what is the actual transaction that's happening here and what do I need to record. Now, every single time we have a transaction in accounting, at least 2 accounts are going to be impacted. Now, the basics for this, from just kind of a mathematical perspective, is that we have to keep our accounting equation in balance. Assets equals liabilities plus stockholders' equity. That has to all stay in balance. If we get anything on the asset side, it has to be financed over here from either debt, liabilities, or equity. So it has to be financed by something. And the reason is that we don't just get something for nothing in businesses. Nobody's giving us anything out of the goodness of their heart. We're selling something or we're buying something. There's always a transaction that is happening, and we have to record that on our books. We have this double entry system where at least 2 accounts are impacted to essentially make sure that we don't forget anything. So when we're building journal entries, part of the mechanism of keeping this accounting equation in balance is debits and credits. And maybe you've heard this term before and you're not quite sure where to get started. That's what we're going to start with. Now, in order to know, is this a debit or is this a credit, we have to talk about the account types and what their normal balances are. Now, when I say normal balance, what I mean is what makes this account go up. So when you hear normal balance, think, is it a debit that makes this account go up, or is it a credit that makes this account go up? So when I think of these accounts, I use this thing called the DEALOR acronym. So we have DEA on the debit side, and we have LOR on the credit side. So DEA on our debit side. These are all of our accounts with normal balances that are debits. So they increase with a debit. This also means that when we see them on our balance sheet, it is going to be a debit balance. Typically, we say a normal debit balance. So what are those accounts that go up with debits? We have our dividends, we have our expenses, and we have our assets. So all 3 of these accounts go up with debits. Now, on the flip side, that means that all 3 of these accounts are also going to decrease with credits. Now, I will say we don't often see credits to our dividends or our expenses. If we see credits there, it typically means that we're doing a reversal. But if we want to decrease an asset account, that does mean we're going to see a credit to our asset accounts. Now, on the flip side of this acronym DEALOR, we have our LOR. Our LOR accounts are accounts that go up with credits. Their normal balance is a credit. We increase them with credits, and when we see them on our balance sheet, we can say that the number that we see on the balance sheet, it is a normal credit balance. Those accounts are liabilities, owner's equity, and revenue. LOR. So all 3 of these accounts are going to go up with credits, which means they also go down with debits. Now, here's a little piece where I think a lot of people get confused. Because assets go up with debits, we have a natural inclination to think, yes, debit's good, credit's bad. I mean, if liabilities, what we owe, debt, if that's going up with credits, assets good, debt bad. That is not the case. So revenue is ultimately going to increase our retained earnings, which is going to increase stockholders' equity. So revenue, even though it might feel counterintuitive to you, goes up with a credit. And expenses, again, even though it might feel counterintuitive, expenses go up with a debit because they're decreasing our stockholders' equity. So I have a 4-step process for identifying what is the journal entry in this transaction. Now, right now, I'm just talking about transaction journal entries, meaning typically there's going to be a third party or external party to identify. And it's pretty easy to figure out. We buy something from somebody else, we, take out a loan. There's typically a third party involved. And I'll talk about adjusting journal entries later. Right now, let's just talk about how to identify the journal entry in a basic transaction. Again, we know that at least 2 accounts have to be impacted. More than 2 can be impacted, but at least 2 two have to be impacted. So step one, we're going to want to identify the accounts. Oftentimes this is pretty obvious. So we're going to read through a transaction, say Company A buys land from Company B for $100,000 in cash. So we can identify the accounts. We have land, which is an asset, and we have cash, which is also an asset. Now, what is step two? I like to figure out whether these accounts are going up or down, and that's going to tell us whether this is a debit or a credit. So step two, is cash going up or down? Well, it depends on whether we're talking about the perspective of Company A or Company B. So we always have to pay attention to what perspective are we looking at. Now, when I think of financial statements, I like to think of financial statements as telling the financial story of a company. Just like books have a point of view, financial statements also have a point of view. So let's say that we are Company A, and we are looking at the books of Company A. Company A buys land from Company B for $100,000 in cash. So Company A obtained land. So for A, land, an asset, went up. So we know that land went up. Now, what was the other account that we identified? We identified cash. Company A paid cash. So cash went down. So now we can just go back to our DEALOR acronym. So if land, which is an asset, is increasing, then of course we have to debit land. Now, if cash, which is also an asset, is decreasing, we're going to have to credit cash. So we've gone through the steps of figuring out what is the account and is it going up or down? And now step three, is that going to be a debit or a credit? So we are on the final stage, step four, which is just figuring out what is the amount. So when we look at this transaction, Company A bought land for cash. It was $100,000. We're just going to see debit, land, $100,000, credit, cash, $100,000. We've built our first journal entry. Now, when we're thinking about journal entries, I like to think about journal entries as changes. What is changing for this company that we have to record? Because ultimately, when we look at our balance sheet, that is going to have or reflect an accurate financial position of the company at a certain point in time. So we're making this journal entry, we're making this change to reflect that, hey, Company A now has land and now has less cash. So that is the whole point of the journal entry, is to make that update and have that reflected on our financial statements. So let's go through a few more journal entries to kind of figure out what is happening. So let's start. We're going to talk about Company A. So when I say Company A, that's the perspective that we are talking about in this video. We're recording anything for Company A. So let's say that the public, somebody, they purchase $25,000 of common stock in Company A. So that's the first transaction. They sell $25,000 of common stock to shareholders. So what are our two accounts involved? Well, Company A received cash. They received $25,000. Now, what is the flip side of that transaction? They gave away part of the ownership in their company. They sold stock. So we have our two accounts. We have cash, we have common stock. Now, what's happened to those accounts? Cash went up. So cash went up. Now, what happened to common stock? Well, when we issue common stock increases. So we're going to have a debit to cash because it's increasing, and we're going to have a credit to common stock because that is also increasing. They sold it for $25,000. So what are we going to see? Debit to cash, $25,000, credit to common stock, $25,000. Now, transaction number two. Company A purchases $800 of office supplies for cash. So what are our two accounts involved? We have cash, pretty easy to identify, and then we have supplies or office supplies. So think about what those accounts are. Cash is going to be an asset, supplies also going to be an asset. So what did Company A do? They purchased supplies. So we're going to see an increase to supplies because Company A got supplies. We have an increase to their asset account of supplies. And then we have a credit to their cash account because cash is decreasing. The amount was $800. So we have a debit to supplies, $800, credit to cash, $800. Now, for the most part, when we are recording journal entries, we are recording things at their historical values, historical numbers. So in accounting, we are recording something that essentially already happened. So we're just worried about what is the transaction that occurred on that day. And that is what we are recording on our financial statements. It can be a limitation, but right now when we're just learning about journal entries, just think about what is happening right now. All right, now company A purchases equipment on account for $4,500. So company A purchases equipment on account. Typically, when you hear the terms on account, you can generally think either accounts payable or accounts receivable. What changes and how you know which one it is what is the perspective of the company? What is the perspective we're looking at? So if a business is purchasing equipment on account, they're purchasing equipment on credit, meaning they're going to owe whoever it is that they're purchasing this equipment from, they now owe them money. So that's going to be accounts payable. So our accounts that we have involved in this transaction are equipment and accounts payable. Equipment is an asset. Accounts payable is a liability. Both of these accounts are increasing. Equipment went up, accounts payable also went up. So we're going to see a debit to equipment because it's an asset that's increasing, and we're going to see a credit to accounts payable because it's a liability that's increasing. What is our amount? It's $4,500. So debit, equipment, $4,500. Credit, accounts payable, $4,500. All right, transaction 4. Now I'm going to talk about revenue for the first time, and I'm not going to get into revenue recognition quite yet, but I'm just going to talk about revenue in this example, just to build out a journal entry. So let's say company A provides services, meaning they've done the work, which is the basics of revenue recognition, and they receive $2,000 in cash from customers for that work. So they got paid in cash for their services. So what are our accounts involved? We're going to start with cash. It's the easy one to identify. This video is not about revenue recognition, but when a company does the work, they can record revenue. Now, revenue is increasing. We saw an increase to revenue. They've done some work. They've earned some money. So we see a debit to cash for $2,000, and we see a credit to revenue for $2,000. Now, sticking with the same example, what if the business provided services and the customer paid on account? So what happens then? Well, in this instance, we're going to see a debit to accounts receivable because they're going to receive that money from the customer in the future. They're still going to record a credit to service revenue or a credit to revenue, and it's going to be $2,000 for each. So when we're recording revenue, we're really concerned with when did the company do the work. Now let's do transaction 5. The company A pays $900 in cash for their monthly rent. Let's just assume they're just paying for this rent for the current month. So we're going to see rent expense is one of our accounts. And the other one, they're paying the money, that's cash out the door, so our other account is cash. So we've identified our two accounts. Now what's happening? Cash is going down, so cash is decreasing for company A. Now what's the other account? Rent expense. Now we're seeing an increase in an expense, which is going to be a debit. So we have a debit to rent expense and a credit to cash. What's the amount? $900. Debit, rent expense, $900. Credit, cash, $900. Now, those are the real basics of how to build a journal entry. In future videos, I'm going to talk about adjusting journal entries, how we identify adjusting journal entries, what do adjusting journal entries look like, and I'm also going to talk about expenses and revenue recognition. So stay tuned for those videos, but let me know if you have any questions on how to build the journal entry, and if you have anything that's still confusing you, please let me know.